Hey guys, welcome back to the channel. Today we are going to be covering everything that you need to know about investing in a fund. We're going to be covering what a fund is, the different types of fund, all the different types of jargon that you might come across if you are going to invest in a fund. It's going to be a fund fiesta. So make sure you strap in because after this video, you're going to be armed with the knowledge that you need to go away and start investing in a fund of your choice. So let's start off by covering what exactly a fund is and why you should be interested in investing in one. So a fund, quite simply, is a collection of investments, and those investments can be in company shares, in bonds, in property, in any type of asset class that is actually specified by the fund manager. Now, the reason that you should be interested in investing in a fund is because it gives you exposure to tons of different types of companies as specified by the fund manager without you having to go away and purchase tons of shares in all of these different companies. So, for example, recently I invested in a fund that said its objective was to invest in the biggest companies in the UK, the top 100 companies in the UK. So rather than me being like, well, I want to invest in the top companies in the UK and then going away and buying a share in Tesco, in Sainsbury's, in Marks and Spencer's, whoever, I can quite simply just buy a single share or a single unit in one of these funds, and immediately I've got exposure to all of those different companies that I just mentioned there. Now, typically, a fund will be invested in at least 20 different companies, sometimes as many as 200. So like I've just mentioned, that offers great upside because it means that you only need to buy one time. Only need to incur one dealing charge rather than yourself just going out and buying tons of different shares in different companies. So funds have grown in popularity over the years because they've become increasingly accessible for investors. They're much cheaper than investing in lots of different shares. And it's a great way for beginners to get introduced to investing in different companies. And above all, the benefit is that there's not really too much kind of investigative work needed by you because you're investing in a fund that is managed by a fund manager. And their job is to essentially look at the investments that they've made and decide whether they're good or bad. So it takes the headache out of investing, and it's basically a great way at getting exposure to the financial markets and to different companies that you might be interested in investing in. So if you're going to be investing in funds, it's really important that you know that there are two main different types of fund to invest in, and those are passive funds and active funds. Now, a passive fund is quite simply one that aims to match the performance of a particular stock market index or an industry. So, for example, recently I invested in a passive fund that said we're just going to be investing in the top 100 biggest companies in the UK. Quite simple, right? There's a list of the top biggest companies in the UK known as the FTSE 100. So I'll put that up on the screen now. And you can see it's just listing all of the biggest companies by their valuation size. So the fund that I've invested in will basically invest in all of those different companies, and the investment size will be based on how big the company is. So it's relatively straightforward. And because of that, because of the fact that you haven't got an active fund manager that's saying, I don't want to invest in this or I do want to invest in that, the fees are quite low. So you can invest in a passive fund for as little as, I believe, like 0.2% charge per year. So it's very, very low. Now, conversely, the opposite, the other type of fund is an active fund. And that is, as you might expect, one where you've got an active fund manager who every single day is looking at the investments that the fund is made. And the fund manager is going, okay, I don't like this company anymore, so I'm going to sell shares in it. Or I like this company over here, I want to invest more in it, and so on. And because of the fact that you have got an active fund manager who is doing that analysis, the fees are a bit higher. So typically for an active fund, fees can be as high as like 1.5 to 1.8% per year. But the upside of that, like the reason that you're paying that additional amount is because you've got a professional who is looking at all the investments they've made and they're trying their hardest to outperform the market. So the passive fund will be, investing in, say, the top biggest companies in the UK. And because of that, it can only really do as well as the top biggest companies in the UK are doing. Whereas an active fund can outperform the top biggest companies in the UK because it can be, investing more in a particular company or investing less and so on. Now, an additional benefit of having an active fund manager is that if there's a recession or share prices are going down generally, the fund manager can say, okay, I don't want to invest in these companies anymore because they're going to suffer a lot during the recession, and they can therefore give you downside protection. Whereas with a passive fund, you're just invested in the top biggest companies in the UK as an example, and that's it. So whether share prices are going down or not, the holdings are not going to change. So active and passive funds do both have their pros and cons. The main pros of a passive fund being that you have lower fees and it will just track in line with the market. And the main pros of an active fund is that you've got an active fund manager that can outperform the market, possibly, but not guaranteed. And they can give you downside protection in a recession. So it's really important that that distinction is made, and you don't just think of it as, well, the passive fund is cheaper. Now, passive funds have grown in popularity massively recently, and that's just because it is very, very hard, really, to outperform the market. So at least you know that if you do invest in a passive fund, you're going to perform in line with the market or index that you've chosen. So now that we've covered what an active and a passive fund is, it's also important that we run through another kind of subcategory of fund that is an accumulation fund or an income fund. So an accumulation fund is quite simply one that reinvests any dividends that it receives into more companies, whereas an income fund will collect any dividends that it receives and it will pay those out to the investors, i.e. you or I. Now, there's different benefits of each one. I would say that personally, if you're invested for the long run, then you'll probably want to go with an accumulation fund. And the main reason being that you're going to benefit from compounding, so reinvesting dividends received. And one of the biggest upsides of that is that there's no charge for that. The fund manager will collect the dividends paid from the companies that it's invested in, and then they'll just reinvest it, and there's no charge for you. Whereas an income fund, I would say, is probably better if you're looking for a regular income, or if you're a bit older and you want to receive that regular income. And obviously you'll receive that money in the form of a dividend, and you can go away and spend it on whatever you like. Now, if you're not familiar with what a dividend is, quite simply, it's where at the end of each year, certain companies will look at all the profits that they've made and they'll say, well, we don't really want to reinvest it in our own business, so we're going to pay out all of those profits to our shareholders. So they'll say, okay, we made this amount of profit this year, we're going to pay 30% of that out to all of our shareholders. So that's exactly how it works. And in summary, I'd say it's better to go for an accumulation fund if you're invested for the long run. Now, in addition to active and passive, accumulation and income, there are two other types of fund that are worth knowing about. And I don't want to overcomplicate explaining funds to you because I feel that it is getting quite complicated now. But this distinction here is worth knowing about. And I will put a structure chart on the page now to kind of help you visualize what I've explained in this video. So there are two different types of funds that you can invest in terms of how you go about investing in them. There's a mutual fund and there's an exchange traded fund. Now, an exchange traded fund is typically going to be a passive fund, and it just means that it trades on an exchange, a stock exchange, just like shares do. So that means that if you want to buy a unit or share in a fund, if it's an exchange traded fund, then you can do it at any time in the day, provided the markets are open. And the markets are open Monday to Friday between 8 a.m. and 4:30 p.m. And because of the fact that an exchange traded fund is trading on a stock exchange, it means that the price will fluctuate throughout the day. So if at 1 o'clock you want to buy, one of these exchange traded funds, you can log on to Hargreaves Lansdown or Vanguard or wherever, and you can see the price moving because it's actively trading. And you can say, right, I want to buy £25 worth. You put £25 worth in and you will buy that share immediately because it's traded on an exchange. Whereas conversely, a mutual fund doesn't trade on an exchange, and essentially at one time per day, the fund manager will work out what the value of the fund is. They'll say what the price is, and then they'll publish that on their website. Now, once they've calculated and published the price of the fund, it will update. I think it's around 12 o'clock, and you can log on, you can see the price for like the next 24 hours, and you can choose to buy. Now, when you buy, the main difference between a mutual fund and an exchange traded fund is that it's not instant. Because it's not traded on an exchange, you'll submit your order, and then that order will be sent to the fund manager, and they'll be told that, Janssen wants to buy X amount of units in this fund. And then what will happen is they'll collect all those, like all the collection of money, all the orders, and then the next day they'll then place the order and they'll invest in all the shares that the fund is invested in. And it's a slightly delayed process versus the exchange traded fund, i.e. it's not instant, but that is essentially the main difference. Now, mutual funds are more commonly active, so they've got an active fund manager, whereas an exchange traded fund is more commonly a passive fund. So exchange traded funds, the fees are typically very, very low, and mutual funds, the fees, because they're usually active, are higher. But that's not the case for all of them. You can get mutual funds that are passive that have very low fees, and you can get exchange traded funds that have higher fees. But that's just something that's worth knowing as well, because maybe you're going to invest in a fund and you don't realize that it's a mutual fund, and you might panic when you buy and then you see that the order just says pending for like the next day or so. The reason for that is because, as I've mentioned, it's only once per day where the price is published, and once per day where the fund manager goes and actually allocates you your share in the fund. So if you're anything like I was when I first discovered funds, you're probably now on the edge of your seat, desperate to start investing in these funds. So you might be asking, well, how can I do that? Where do I go? Now, in the UK, there's plenty of choice in terms of where you can invest in a fund. Ones that I know of are AJ Bell, Hargreaves Lansdown, 212 Trading, Vanguard, Halifax. Honestly, there are tons out there. The one that I use is Hargreaves Lansdown, and the reason for that is that they've just got the biggest selection of funds that you can choose from. So you can choose from funds that invest in various certain industries, certain countries. Like, there's honestly so much to choose from. You're really spoilt for choice. The others are cheaper, but they don't offer quite the same selection. So let's now cover the fees and charges that you need to be aware of when investing in a fund. So the first fee or charge is a platform charge, and that is charged to you once a year by whoever you're investing through. So me, for example, my funds are invested with Hargreaves Lansdown, and they charge me 0.45% every single year. Now, depending on the platform that you've gone with, you can either be charged a flat fee or just charged a percentage of whatever you're invested in. Hargreaves charge a percentage of whatever you're invested in. You've also got AJ Bell, who I believe charge a proportion as well, but I think it's a bit lower, about 0.3%. And then you've got Vanguard that charge 0.2%. The different fees, I don't remember off the top of my head, but I will do a video in the future. But that is a fee that you definitely need to be aware of. Then secondly, you've got the fund manager's charge. So as I mentioned earlier on, with an active fund, that fee is going to be a bit higher, or significantly higher actually, than a passive fund. The highest that I've seen is about 1.5 to 1.8%. But with a passive fund, that fee is going to be negligible. You can invest in a passive fund for as little as 0.1%. Those fees have been coming down massively lately as competition has really increased within the passive fund space. So that's the second charge, the fund manager charge. And then you've got the dealing charge. So Hargreaves Lansdown don't actually charge a fee for you to buy one of their funds. Whereas some of these other companies, I believe AJ Bell charges £5 to £10 every time you buy a fund. So that again is something to be aware of. And that should kind of play into your like decision making when you're thinking about which platform you want to go with. So those are the 3 fees that you need to be aware of when investing in a fund. So now that we know the different types of fund that there are, the different fees involved, and where we need to go to actually buy a fund, let's now cover how do you go about choosing a fund to invest in. So just like with any investment that you make, before you decide what to invest in, you need to consider your goals, your attitude to risk, any views that you may have got on a particular sector or geography, and your existing exposure. So for the existing exposure one, for example, if you are already invested in like a ton of US tech companies, then what you don't want to do is invest in a fund that has got a heavy amount of exposure to those same companies. The aim of a fund is to stay as diversified as possible. So make sure that you think about existing investments before deciding what fund you want to go with. Now remember that every fund has got a different fund manager and it's got different goals and different levels of associated risk. Some fund managers are very cautious and they'll say this is a cautious fund that just aims to, invest in mature companies, whereas other funds will say this is a high growth fund and we're investing in riskier companies based in, I don't know, Latin America or whatever, a riskier region than say America. So make sure you again consider that. You need to read up on what the fund style is, what the objectives are, and then see if that matches your own objectives. Now, deciding which fund to invest in can be as simple or as complex as you make it. If you just want to keep things simple, you might just say, okay, I just want to get exposure to companies in the US, or I just want to get exposure to companies in Asia, or whatever. And if that is what you want, then there's funds for that. Whereas conversely, if you do want to get a bit more detailed and like really drill down into a specific niche, then you can just invest in a niche, invest in a fund that has exposure to, I don't know, like energy companies or healthcare companies or whatever. So it really doesn't need to be that complicated. When I first started investing, I just thought, I just want exposure to companies in the US like Amazon, Facebook, etc. I want exposure to some companies in the UK, so like Tesco, Sainsbury's, and so on. So I just invested in a fund that was invested in the biggest companies in the US and a fund that was invested in the biggest companies in the UK. And there's nothing wrong with that. If you want to be even more diverse than that, there are funds that you can invest in that are just called global funds, and they invest in companies that are across the world. So the US, South America, Asia, everywhere. So it really just comes down to your own preference, your goals, and your attitude to risk. Obviously, if you invest in a global fund, that's going to be a little more diverse and lower risk than investing in, I don't know, a fund that has exposure to healthcare companies in South America, for example. So just take that into account. And, as I've mentioned earlier on in the video, you can just browse the different types of funds by going onto websites like Hargreaves Lansdown or Vanguard, and just quite simply look at the selection of funds that they have and then decide for yourself which one matches your risk profile and your objectives and your general views. So before we finish the video now, let's cover the essential things that you need to know if you're going to go away now and invest in a fund. So the first thing is that there is no guarantee when you invest in the stock market. Prices can go up and prices can go down. So that means that your initial investment, whatever you put into a fund or a share, the value can go down and you need to be aware of that. Of course, the value can go up, but you also need to remember it can go down. And when you're looking at past performance of a fund, if you see it's grown by 10% every year for the last 5 years, you should not, I know it's hard to do this, but you should not take that into account when considering whether you want to invest in it. Past performance is not a guarantee of future performance. So just take that into account, and remember, when you're deciding to invest, you need to consider your goals. So how long are you going to be invested for? Your kind of objectives. So do you want to be slightly riskier, have riskier exposure or less risky? and so on. In terms of how long you should be invested for, I would say fund investing is for people with long-term goals. So you should not be investing in the stock markets really if you're going to need the money in 6 months. Say you're saving for a house deposit or you want to buy a car or whatever. And the reason for that is, as I've said, stock markets are volatile, the value could go down, and if you're investing for 6 months, there's a chance that you could lose a proportion of your money. So the guidance out there on the internet and generally with investors is that if you're going to invest in funds, it should be for a minimum of 3 years. Ideally, it should be 5 years. So it's great if you're able to regularly save and you're not going to need the money in the next 6 months or whatever. Funds are a great way to increase your wealth over the long term. Now, as I've mentioned throughout this video, each fund has its own objective or goal that it's trying to achieve. Some funds invest in certain geographies, others invest in certain industries or type of investment, so shares or bonds or property, and others just invest in a certain market, so the biggest companies in the UK or tech companies in the US, for example. The important thing to note is that funds should be used to help you diversify. So as I mentioned before, if you already have tons of investments in US tech companies, then you shouldn't be investing in a fund that also has a heavy exposure to that niche as well. So try and go for funds that have exposure to areas that you don't already have exposure to in order to allow you to benefit from diversification. Now, the final thing to be aware of is if you are going to invest in a fund and you are based in the UK, you should be investing through a stocks and shares ISA. So an ISA stands for Individual Savings Account, and it is basically a type of account that doesn't get taxed. So that means that if you buy your funds through a stocks and shares ISA, any gains or profits that you make on those funds are not going to be taxed. It's completely tax-free. Now, there is a limit to how much you can invest in a stocks and shares ISA. The limit is currently £20,000 per year, and each year ends at the beginning of April. So if you're looking to invest now, make sure that you invest in a stocks and shares ISA, and that way you're not going to pay any tax on any gains or income that you get as a result of investing in those funds. So that is it, guys. That is pretty much everything that you need to know about investing in funds. I really hope that you've learned a lot from this topic. I realize that it is quite a complicated area of the investing world if you don't have any experience of it. So I hope I've simplified it for you. If you do have any questions about the topic, or if you've got requests, if you want me to go into more detail in a certain topic in a future video, then do let me know in the comments. If you have enjoyed this content, please remember to subscribe. I'm going to be doing lots more content around the investing world in the future, so you don't want to miss out. Thanks very much for watching, guys. I will see you next time.